So, good day, traders. It's Forex Evangelist right here, and welcome to today's video. From the thumbnail, you are going to see the theme of this video, which is economic indicators. Now, what a whole lot of retail traders is aware of is the technical indicators like RSI, MACD, Bollinger Bands. But you need to understand that those things are lacking economic indicators. We are talking about economic indicators that help gauge the strength of the economy. So by definition, we can say that economic indicators are data, they are numbers, they are figures that help tell traders, analysts, investors the strength of an economy. Okay, so they use that to understand if they are going to buy or sell a financial instrument like currencies, commodities, stocks, and all of that, even cryptocurrencies. All right, so that is what economic indicators is in a nutshell, or by definition. So we're going to be talking about next the types of economic indicators. We're not going to be going deeply into these types of economic indicators because we are going to dedicate separate videos for each and every one of them. But just as basics, we are going to mention them and give instances with real-time examples, things that happen around us. Like real events, not actually real-time, real events that happens around us every day. Okay, so talking about the types of economic indicators. Types of economic indicators. So we have one, leading economic indicator. We have two, the coincident economic indicator. And we have three, the lagging economic indicator. Okay, the leading, the coincident, and the lagging. Now, this is what you need to understand first about economic indicators before we move deeply into this. Now, ask yourself, what is the reason? Why is it that when CPI data is released, NFP data, yes, is released. I'm using the US economy as an example right now. You see the market react so much. Okay, you see the market react heavily. Now, it is because investors are paying attention to those data, because those data is what the central bank is going to use, to make their decision, which is going to either make the currency strong or weak by raising or reducing interest rates. But all of those things start from somewhere. Now, talking about leading economic indicator, let's use the raining season as a case study here. Before rain falls, you are going to see dark clouds. It's going to come with winds. All right. So this is like leading economic indicator, not the actual rain. The actual rain, yes, but it's telling you that probably rain is going to fall in a couple of minutes. Maybe if you have clothes outside, or maybe anything that is under the outside that probably rain is going to beat and spoil, you most likely go that time to go and bring it in. Okay, you are not actually going to wait for rain to beat, like rain to start raining before you're going to go and get those things in. No, you're not going to do that. Okay, even if maybe you don't want to bring it in immediately, but you now get ready, your hands will be on the trigger per se, you'll be ready, anticipating rain to fall. So that is exactly what leading economic indicator is. And like I said, in the subsequent videos where we are going to be discussing each and every one of these indicators separately on its own, we are going to be discussing the types, okay, that really matters as a leading economic indicator. So this is what leading economic indicator is all about. It helps tell you, it turns before the economy turns. It tells you the economy is probably going to get weak in the future. The economy is probably going to get strong in the future. Let me just give one example. Okay, one example is like the PMIs. Okay, the Purchasing Managers Index, either from the manufacturing or from the non-manufacturing, which is the services. They are examples of leading economic indicators. They tell you things in advance because those data are surveys. So leading economic indicators, just to give you an expo before we move into the video we're going to be talking about, these indicators individually, is there are usually surveys for leading economic indicators. When I mean surveys, when somebody will go and ask people questions, maybe ask businessmen and women, okay, ask them, how are you feeling about the economy? Do you think you are going to make sales, in the next 1 month, 2 months, 3 months? What is your perspective? How is business so far? So the answers of those people is what will be gathered. Okay, just to give you an example. All right. So when we say coincidence economic indicator, this tells us what is happening, in the present. So using, rainy season as an example, during in coincident economic indicators, it's like the actual rain falling, telling you how the economy is right now, the gauge of the economy right now, if the economy is actually strong or if the economy is what, weak. An example of this coincident data is retail sales and industrial production, manufacturing production. These are some examples of coincident economic indicators. And the last one is lagging economic indicators. So when we say lagging economic indicators, this comes just to confirm the trend of what we have seen from leading, coincident, and lagging. And mind you, let me take you back to leading. Leading economic indicators, you use them to get ready. Remember, not to actually trade, but you want to position yourself if the opportunity is coming, all right? Because their signals can be false. Why? That is the reason I used rainy season as a case study. Remember, sometimes, you could see those dark clouds, with strong wind, but after a couple of minutes, it doesn't rain anymore. Okay, this happens every time. All right, after a couple of minutes, you begin to say, upon what happened, everywhere was dark and everything. Still, this rate didn't fall. So leading economic indicators can be false at times. All right, so you just use them to get ready, and now use coincident economic indicator to actually take action. Okay, regardless of what leading economic indicators is communicating to you. Now, lagging, you use it to confirm the trend. When lagging economic indicator comes, now if it is now giving you something different from what coincident economic indicators is telling you, maybe it's that point you begin to book profits. All right. And if it's giving you maybe on the same page, okay, maybe you can actually scale into more position, but understand that the trend is confirmed and probably 70 to 80% of the move must have happened. Okay, so that is for coincident economic what indicators. So there is a whole lot of economic indicators. Now we have talked about types, but in terms of economic indicators, there is a whole lot. But in subsequent videos, like I said, I'm going to be discussing each and every one of them step by step. We have the GDP, like an inflation rate, CPI, which is a measure of inflation, and all of them. Consumer confidence, which is a leading economic indicator. I don't want to spill out everything because I want to use a separate video to discuss each and every one of them. So again, what you need to understand is that the central bank is always using these economic indicators to make their decision. Remember, the market moves based on data and expectation. So it is the data that the central bank is seeing before them, how the economy is faring, is what is going to make them to hike interest rates, which is, most times going to make the currency to be strong. That means the currency to buy, or cut interest rates, which is most times going to make the currency to weaken and sell. And even traders, analysts, and investors are looking at these data, economic indicators, to make the analysis to know if they are going to buy or if they are going to sell. Okay, when they make this analysis to have their bias of a particular instrument, maybe gold, maybe oil, we say, okay, we're expecting gold to buy because of, we're expecting gold to sell because of. Now ask yourself the reason why. Maybe if you are watching Bloomberg, if you are used to it, watching some of these financial channels, CNBC, when you see a trader being invited, probably from one of these big institutions, maybe a hedge fund, an investment bank, and all of that, and they ask them, maybe, sir, why do you think gold was falling maybe during the US Iran war? you won't hear those guys saying gold was falling because I saw a pin bar reversal candle, an inverted hammer, or an engulfing candle, blah blah blah. No, you won't hear them say such things. They are going to tell you the fundamental reason behind that. You will see them say things. Now, using that US Iran as a case study, now during that war, you will notice that okay, because of the blockage of Strait of Hormuz, it affected the supply of oil because it's going to create scarcity. There is panic if Strait of Hormuz is blocked because 20% of global crude oil passes from that place. So if there is no oil again, it's going to be expensive for, in terms of food, energy, transportation, all of that, which is inflation. And when we say inflation, if inflation simply means, the increase in price of goods and services, okay, and this is supply side inflation. And in this scenario, inflation is a double-edged sword, okay. It's not going to favor countries like Europe because they are heavily dependent on that, but countries who produce oil is most likely not going to affect them. And one of them is US. The reason why the US dollar was gaining, because US was making more money if crude oil prices are high. And still, the inflation is still going to enter into the economy. And we are expecting, the central bank, as a result of that inflation, to raise interest rates in the future, okay, to control inflation. And that is the reason why investors were dumping gold and buying dollar. And that is why gold USD, during that time period, was pushing to the downside. Because gold is not a yielding asset. So, and also, even though some people will say gold is a hedge against uncertainty, but dollar as well is also a hedge against uncertainty as well. It's a safe haven as well. So in that scenario, investors will now weigh to say, okay, which one are we going to go for? Okay, this and this are safe haven. Okay, but here we are not going to get interest in terms of gold, but in dollar we are going to get interest. So simple. So SEUSD will do what? We push the downside. So that is basically how institutions, banks, and professional traders look at the market using economic indicators, data, and things that are happening. I just explained a little bit of geopolitics, but how is incorporated into data, moving into inflation and central bank actions, to tell the strength of financial instruments. So I believe this video is helpful, and like I said, expect more. You are going to be learning a whole lot, not just technicals but fundamentals, understanding what really drives the financial market. My name is Godfrey Moka. You can call me Forex Evangelist. So don't forget to share this video to other traders who are struggling to understand this concept. Like, subscribe if you have not, and click the bell icon to get notification anytime we post similar content on this channel. Thank you very much, and see you in my next video. Bye for now.